We're live.
Go ahead, Mr. Foster.
Okay, we will proceed to call the meeting to order of the Actuarial Committee. Thanks everyone for being with us today. And let's have the reading of the opening statements this time, please.
All right. This is a regular meeting of the County Employees Retirement System Board of Trustees Actuarial Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pension Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. The connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
All right, thank you very much. Sherry, for the record, let's have a calling of the roll, please.
Yes, sir. Mr. Foster,
Here.
Dr. Carver,
Here.
Mr. Cheatham,
Here.
Dr. Hackbart,
Here.
and Mr. Webb.
Here.
Thank you.
All right, thank you very much. Sherry, for the record, do we have any public comments?
Yes, sir. We have two, and I will read them now.
Okay.
First one has been submitted by Perry Murphy, and they write, support House Bill 406 and implement additional 13th check for CERS retirees. The second one we received was from Lee Kimber, and it simply reads, support House Bill 406. Thank you.
All right, thank you, Sherry. You should have before you a copy of the minutes of our meeting in November of 2025. Are there any additions or corrections, deletions to those minutes? And if not, I'll be happy to entertain a motion to approve the minutes as presented.
I so move.
We have a motion
Second.
to approve the minutes. Is there a second?
Second.
Well, I have a motion and it's been properly motioned, and we have a second, so we'll proceed to vote. All those in favor of approving the minutes as submitted, please indicate by saying aye.
Aye.
And does anyone, if anyone opposes, they may say nay at this time. Hearing none, the minutes are adopted. Next on our agenda, we in our spring meeting of the committee, we typically have our investment consultant, Wilshire, to give us a report that indicates forward-looking return expectations. And I'd like to turn it over to this group now to give us your report and accept any questions that the board members may have.
Great, thank you. If we could, Sherry, go to slide number 9 in the deck. Perfect. So as part of the work that we do for CERS, Wilshire will conduct a strategic asset allocation every 3 to 5 years. The last one we did was at the end of 2023. And as part of the inputs to that work, we produce capital market assumptions. And those capital market assumptions are outlined in our annual return and risk paper. But as part of that work on an ongoing effort, we also take the current economic data, plug those inputs into our models, and we update those return assumptions each quarter. What you see before you is the compound annual returns for each of the asset classes that we model on behalf of CERS, as well as your target weight, which is your current strategic targets for each of those different asset classes. And I'll just outline that the full methodology is included in that annual paper. But if we look across over to the far right-hand column, one of the key inputs that your actuary will use is the total portfolio return, which is listed at 6.18%. That's a compound annual return number. Which is very similar to the work that we did a couple of years ago when we actually went through the asset liability study. There has not been a lot of change between the total expected return at that point and even through the end of fourth quarter. It's only about 10 basis points difference. I would like to point out that that 6.18% return is only the asset class return. This is assuming that you're investing passively within each of these asset classes. There is no active management included in that return assumption. So when you look at the difference between your discount rate and the expected return on your portfolio today, while it is slightly under your discount rate, it does not take into account any active management return that you would potentially receive as you implement the portfolio. If we go to slide 10, and I'll just keep this very brief. This is a summary of some of the quarter-over-quarter changes that you can see from some of the broad asset classes. And this really kind of tells us the direction the market is moving. You can see that inflation and cash equivalents in the upper right-hand chart have come down very modestly, only about 5 basis points. And conversely, treasuries, long-term core bonds have moved up ever so slightly, 5 basis points. We see some a little bit higher changes in real estate securities and private real estate, 10 to 15 basis points. And I just wanted to point out the public stock market has actually increased from third quarter 2025 to our year-end assumptions by about 30 basis points, 35 basis points across different regional assumptions. And that's largely driven by one of the models that we use within public equities is called our IGV model, or income growth and valuation. And based upon a lot of the communication that we've received out of the Fed, we do expect the markets to have run at a little bit hotter level, as they've said. And one of the key inputs to that model is that growth rate we've taken up from a 2.5% to a 5% level. So that is what's really driving a lot of that expected public market return moving up from third quarter to fourth quarter, because that was an input change in the model. If we go down and look at the implied risk premium, I want to call out the US stocks minus core bonds. You will see that we actually had a negative implied risk premium, or a negative implied risk premium, if you will, of stocks over bonds, which was at 80 basis points over third quarter. And in the fourth quarter, that actually, the number increased largely because of the increase to that growth, or that stock, public market stock. And that change has increased 35 basis points. So our negative equity risk premium has actually come from 80 basis points to 45 basis points. If we move to slide 14, I'd like to call out here, if you look at the left-hand chart, which are the nominal returns for each of these kind of high-level asset classes over time, and that red line, think of that as your ultra long-term, what we have experienced from a return for each of these different asset classes over time. And you'd expect, as you move from your low risk cash or treasury out to your higher risk asset classes, you'd expect that line to be upward sloping into the right. And you see that that is very much the case in the red line. As we look at the blue dotted line and the dark blue and light blue lines, you can see that where we're sitting between third quarter and fourth quarter hasn't changed very much, but the relationship compared to the red line, once you move out from about core bonds further to the right, as we move out the risk spectrum, we're actually not getting, or Wilshire is not looking at assumed returns that are as high as what we've experienced over time. And a lot of that is just, quite frankly, the macroeconomic environment that we are in today. So as you look at, for example, US stocks, where you see that dip down from the red line, we do think that the US stock market and public stocks in general are going to have a lower future forward-looking expected return than what we have seen in the past, which is mainly to say that we think that that's going to be a more challenging return environment over the next 10 years than what we may have seen over the past 3, where we've seen public equity markets ramp up 20+%. With that, I'll pause and take any questions that the board may have on Wilshire's capital market assumptions.
Bruce, I'm not sure.
excuse me, I'm not, probably got a bunch of questions. I'm trying to figure out which ones to ask first, but
Okay.
I guess my overall question probably goes back to your assumed rate of return based on our static asset allocation of 6.15, correct?
Yes, just under 6.2%. Correct.
What do you know off the top of your head what our alpha premium has averaged over the last few years?
I don't have that number off the top of my head, but based upon the allocation across your equity, private equity, you got 8% there. That's going to be some of where you're driving your alpha is in that private equity, private credit component. In areas like public equity, you're going to have very modest expectations there. You're going to be, generally, in the 25 basis point realm, let's say, on call it almost half of your portfolio. So that right there gets you that 12.5 basis points, bringing you up a little bit further. And then as you look out towards specialty credit, private equity, that's where you're going to really start adding more of that alpha, because those are more inefficient markets. And if we're able to select and invest with the highest performing managers, which we tend to say in those markets, you have to invest, or you have to be able to invest with those top quartile managers to really earn that premium, then you're going to start seeing higher alpha assumptions out of those asset classes. I don't have an exact number on a total portfolio basis of what you have historically returned.
Chris,
but
I'll just add that through December, the plans averaged about 40 basis points of outperformance over the trailing 5 years over that IPS benchmark. We don't like to rely on historical figures to tell us what's going to happen in the future. So we could look asset class by asset class and come back and kind of calculate a combined forward-looking expectation for what type of value add the managers might provide. But historically, it's been around 40 basis points over the last 5 years, which, if that were to continue, puts you, past that 6.5% threshold.
And I would say that's in the realm of 25 to 50 basis points of relative expectations. But as Craig pointed out, those are going to differ on a year-to-year basis.
Yeah.
Thanks, Craig. I think that's what I guess I wanted to hear is confirmation that historically we've at least gotten that other at least 35, 40 basis points in alpha return. But I know it's not part of your all slide, but just to refresh my memory, I think in our last, I can't remember if it was a board meeting or investment meeting, we think you all shared with us that your top performers, again, on the private equity side, had outperformed what we've been doing by about, what was it, about 3 or 4 percentage points, wasn't it?
Correct. So, and then those are asset classes where we would expect a larger outsized of alpha. And I will just say, when we did the strategic asset allocation about 2.5 years ago, the CERS portfolio was closer at that time with Wilshire's capital market assumptions to 6.3%. So again, with that 25 to 50 basis points, you were comfortably right in the realm of that discount rate.
Okay. It may have been on your slide and I missed it. I know we love to talk about return, but I'm curious if you all looked at the difference in your risk expectation of what our asset allocation was versus now. Has that gone up? Has that gone down? Has it stayed pretty steady?
Great question. And I would say risk in general doesn't change much. Risk and correlation are largely driven off of historical observations. So while we do make slight adjustments on those, they are not going to be nearly as dramatic given market conditions as we would see on the return side. But to your question, the expected risk level was just over 12% using the information from a couple of years ago. And we're now sitting at about 11.65% in the current market environment. So there's a difference of about 40 basis points there, but from an institutional risk of what we see many of our clients taking, they're generally going to fall between 11 and about 13% for a vast majority of public pension plans.
Okay. Thank you. That's all I could come up with.
Great. Happy to take any other questions if there's more.
Do we have any other further questions of Chris and his group? Well, seeing none, thank you very much for that report. Let's now turn our attention to our actuarial report from GRS and can you give us an update on that, please?
Thank you, Ms. Foster, members of the committee. We put together a memo, an analysis of recommended assumptions for the on the economic side for this upcoming valuation. This will be for pension, insurance, has, non-has. Essentially, we, as you can see there in the summary of the table there below, I'm recommending no change. As we go through it, price inflation continue the course at 2.5%. I'll note this one is really just for completeness, that this has no whether it was changed to 2.4, 2.6. If you just look at it on a standalone basis, it has no metrics because none of the benefits are directly connected to what actual inflation is. You don't have, for example, you don't have a COLA tied to actual inflation. Whereas on the investment return is probably the most important assumption, and both Chris and Craig did a nice job summarizing that. On Wilshire's assumptions, we'll go through that in more detail. That's probably your most significant assumption. That was increased, I believe, 3 years ago from 6.25 to 6.5. And then the last one's the payroll growth assumption. This is just for financing the unfunded liability. It doesn't change the liability, the calculation of liability, but how's it financed? And it's amortized over amortization payments that increase at the rate of 2.5% per year. So the idea is, what does your membership payroll change and how the amortization payments change? And, kind of move in sync. You expect payroll to increase generally over time. So to keep your contribution rate or your amortization rate costs relatively level, you build in some of that backloading on that assumption. If we look at price inflation, if we go down the next slide, down below, next page, you can see the actual year over year. This thing is moving, over the last year or so with the new president. It's all over the place. I hear Friday's CPI expectation, the last I heard was 3.4% year over year, largely driven by the change in energy costs. Anybody that's filled up with gas or filled up with diesel is definitely going to know that. But is it temporary and not systemic? It just makes it hard to predict and hard to predict how the Fed's going to react given their dual mandate. But we've got some more information down following on that. Actually, if we just go down to the next couple pages, that's actual historical. If we look at forward looking, you have the federal target to 2%. Now it hasn't been met in several years, so I don't know how relevant it is, but it's still their target. Rather, we look at the bond market, the 30-year, 20-year forward looking. This is the difference between TIPS and constant maturity treasuries. Then you have the Philadelphia Fed survey. It's about 50 economists that come out quarterly. That was their most recent first quarter of 2026. Social Security assumption, what's used and inherent in the Social Security projections or their valuation, which goes through scrutiny. And then on the investment consultants, which includes such as Wilshire, and we've got a survey of others of what their consensus is. So we're on the high side of it, but it's something I definitely feel comfortable with, given where actual has been and the relatively how immaterial this assumption is compared to the others. If we go to the next slide, we'll go to investment return assumptions. So um, this is the most subjective assumption. And as you can see, you see the greatest variability among the different investment professionals. And actually, Sherry, if you can go down just a little more, so we can just show or back out a little bit on the Zoom. You can see the investment names of the investment consultants in the firm or in the survey. For completeness, Wilshire is in there, and we have them in there number 2. Now, as what Chris noted, their most recent assumptions came in at 618. We using their assumptions, and we mapped it independently the best we could figure out. And in aggregate, we developed a 6. So there's a difference there, but I consider really for business making decisions or assumption setting decisions to be irrelevant. I would take their number. They're just closer to the asset allocation and the details among the various equities and fixed income is causing the difference. But so we look at Wilshire, they're your investment consultant, and then we pull together others. The purpose of the others is not because they're necessarily no more or less, but just to give you an idea of what the consensus is or what the range is amongst the investment professional community. And there's various degrees of differences and expectations. And some of these you have to be careful of. Like if you look at BlackRock, since they do a lot in private equity, they tend to favor and think very highly of private equity. So you have to be careful and mindful of some of their assumption sets. Some of that has come down and been more tame recently over versus, let's say, 3 or 4 years ago. And then we've separated them out between what we call short term, 7 to 10 years versus a longer term. Some of them just have long term assumptions, other have short term. Some of them come out with both. A few of them have both short and long term, but we don't want to get caught up or overstrung on any particular one. We're just trying to show you a range or consensus, as well as how that has changed or evolved over time, as well as the probability of meeting your 6.5% return assumption. So there's the consensus there. Actually, if Chris or Craig want to provide any interjection on this, you're welcome to do so.
No interjection, but I will comment.
Yeah.
We do custom model some of our asset classes, so that's largely the difference that Danny is referring to between the 6% that they came up with and the 6.18%. I will also note I did not include the long term, but we do have our 30-year assumption. The 30-year assumption for your current strategic asset allocation is at 7.1%. So if we think about using those longer term assumptions that are going to be closer to that red line we looked at a little bit earlier, your capital market or your strategic asset allocation more than gets you to your 6.5% discount rate.
And Chris, I'll just add a point to that, especially since you referenced the 30-year assumptions, especially in these 10-year assumptions, in general, relative to many others in the marketplace who make capital market forward-looking assumptions, we are, we think, quite realistic about the current valuation of public equities and what that means for an expected return going forward over the shorter period, like 10 years. So part of that difference is most likely, I don't know that I've seen all these, but we've seen plenty of others. Most likely, several of these would have a higher return assumption, particularly for the U.S. equity market over the next 10 years.
David, I think that's correct. What I've seen, and I'm going to generalize, but U.S. public equity was down a little bit. International equity was up a little bit year over year. And then fixed income, I saw different, some were a little lower, some were a little higher. Just, I think it was expectations on where interest rates were going, which is a kind of a tough crystal ball right there. But
sure.
And it's one item where the reason we show 3 years and we try to as we think through this and the assumption for purposes of setting long-term assumptions is we show more than 1 year to show that that there's movement from year to year, and some of it depends on where your new starting point is, as David alluded to. Last year U.S. equities are great, so you have a new starting point. So looking forward, you're going to be a little lower just because of where you ended up last year, and others do the same. It's built in inherent, but we would prefer not to see that kind of volatility when setting a return assumption for an actual evaluation and setting contribution rates.
Yep.
So with that, I'll open up to any questions from the committee. Okay, barring none, okay, was Mr. Webb.
Well, maybe one. I mean, you mentioned briefly kind of the payroll growth assumption financing liability over time. Can we maybe hit briefly on all those assumptions, what the effect is if we come in over or under each?
Yeah, absolutely. And if we go to the next slide, actually on the last slide, we'll cover through on the payroll. If we go down on the bottom, Sherry, right there, change in payroll, how it's actually changed over the years, and what we've seen the last few years is an anomaly. But when you see changes in payroll, you kind of get there's kind of there are two effects to it, and they're a bit offsetting. So first of all, if we're talking about you have change, what is the source of the change of the payroll, and is it just mostly due to individual memberships receiving increases in their personal salary? Well, for tier 1, tier 2 members, if it increases more than assumed, you're going to get a liability loss. Benefits are projected now to be bigger than what they were expected to be. For tier 3 members, that's more muted because it's a cash balance plan. Cash balance plans are career average benefits, just your pay credits for the upcoming year. The second part is how does the total membership have pay? So what we do and this is where you can have an offsetting effect or different effect on how it changes the overall contribution rates. So what we've experienced actually the last couple of years is payroll increases were larger than what we expected, the 2% are assumed. And what they've done is, so we have the same amortization cost. So the amortization cost is a little more predictable from year to year, but now you're spreading that over a larger payroll base. So your amortization rate as a percentage of payroll goes down. And so that'll take down or lower your total contribution requirement. And you can have the vice versa. The risk is if payroll grows less than assumed, and what happens there is it's going to put upward pressure on your contribution rates because you didn't get the amortization dollars you expected because payroll didn't change as much as expected, and so subsequent years you're going to have to collect more and more money to make that up. So having it higher, if you think of the risk being asymmetric, there's greater risk to having a payroll growth assumption too high than too low. And that risk is most apparent when you have a large unfunded liability like CRS non has, and you have a long amortization period like CRS non has. And that's because you have a large amortization cost. If you have a well-funded plan that's 90, plus percent funded, or a short amortization period, then that risk becomes muted because your amortization cost is so low. I can pull it up. You asked about what effect it can have, and at the retreat last October, we provided a slide or so for that. And I could share that for you if it would be helpful for the committee. Let's see, do I have screen share privileges? Sherry, can I have
You should have it now.
okay, thank you.
Uh-huh.
Okay, Mr. Webb, and members of the committee, so I have a screen pulled up that what you're looking for is you're really looking at is the contribution rates for the CRS non-HAS. And so what if the payroll growth assumption is 2% and you actually get 2%, then you're funding along that top blue line. If you assume 3 and you actually get 3, your contribution rate goes down a bit because you're funding over, you're pushing your payments more toward the back end. You're going to get more amortization on the back side or higher payroll growth. But if we go to the next slide and we show this, all right, what if we get 2? What if we continue to assume 2 and we get 2? Well, that's predictable, but what if we actually get more than 2? We get 3 in this example. We can see how the contribution rate changes over time and you get that benefit later on and what that magnitude is, kind of that sensitivity is there. Where I talked about the risk being asymmetrical, and the risk is, what if we assume 3, but we only get 2? So you initially start along the green line, but you're not getting the payroll increases you expected. So they increase over time and you end up at a higher spot than if you just assumed and stayed where you're at in the status quo. So you're shifting, if you increase it, you're shifting or increasing the backloading. And of course, the only thing that really matters on the outcome is what will actually be, and we won't know that till the end. However, if we go back to, if I stop screen sharing and if we go back to the slide of historical, what you saw the last few years is not sustainable. Meaning we don't anticipate those types of salary increases or payroll increases to occur, since 2021 through 2025. We expect them to behave more like from 2015 to 2020.
Yeah, I would agree with that. I think the influx of ARPA funding allowed municipalities to do a lot of other things. So that's a good explanation. Thank you. So from a policy perspective, maybe a good way to think about it is because of where we're at, the risk of shooting too high outweighs being too low. For lack of a more sophisticated way of saying it, like a Price is Right methodology. Like
Yeah.
you want to have something reasonable, but you absolutely cannot go over, or we're really going to be in trouble.
And some history to these committee members. CRS was in a more delicate position back in 2017 before a lot of the assumption changes were made. 2017, there was a 4% payroll growth assumption. And of course, the amortization period there was a pattern of resetting back to 30 years. And so you're not, when those instances are happening, you're not even funding the interest on the unfunded liability. You're having negative interest, or your outstanding balance of your unfunded liability is growing and not shrinking. We're in a position now, if you look at the projections, or the dollar amount of the unfunded liability is now projected to continue to go down. And it's in part of where you are with the payroll growth assumption and the funding period and the other metrics and assumptions built in.
This is probably more of a staff question, but when you get the data, do you have access for that growth? How much is wage growth versus how much is employers adding new positions?
And we're just trying to find out this information.
do you want to repeat that? I'm not sure that Danny heard it.
Oh, sorry. When you get the
Oh.
payroll data, do you get it in a way where you can parse out when you look at year over year growth, how much of the growth is just employers giving kind of an increase, and how much of it is employers creating new positions?
So we do try to we try to get a high level understanding. So yes, I was waiting for staff to respond to it. Sherry, if you just scroll up just a little bit, that's where we pay mindful attention of. That's why we showed both in this chart and the analysis of, are we seeing change in membership and payroll? Because you're exactly right. Part of it can be driven by change in membership, even if payroll changes, or individual salary increases are maybe muted. We try to separate a little bit of that effect. And again, we've seen increases both in active membership for both the non-has and the has over the last couple of years. I think that's as much driven by economic factors as anything, because it's been relatively stable for CERS if you look from 15 to 20.
Okay, thank you.
Just, I guess to go along with what Steve's question is it fair to sit there then and look at those charts and say, for example, the non-hazardous, looks like we've had a 1.8% increase. I assume that's over the last year.
Yes, sir.
In membership, but
Yes,
we've
sir.
seen a 6.3% increase in payroll revenue. So,
Yes. So a big part of it, and
difference there is 4.5%. So would it be fair to say that 4.5% is due to, of that 6.8 is due to increased wages, and the other 1.8 is from increased numbers?
at a high level, absolutely. You could actually be weighed a little more because new hires coming in generally are at lower wages than the average, below average. So the 1.8, you have the 6.3 increase. So maybe, I'm speaking for myself and just gut check, maybe 1.4% or so is due to active membership, just because you realize those, the pay of those new members coming in are lower.
Okay, thank you.
Mr. Chair, that concludes our discussion material over these items on the agenda topic.
Mr. Foster, you're muted.
So give me a call, 270-380-3947. Thank you.
Okay, I think I'm unmuted now. Thank you. Let me know about that. Thanks for that report. We'll move on to the next item on our agenda, which is a discussion of the employer-funded 13th check. And Ed, do you want to take that?
Yes, thank you, Mr. Chair. I appreciate the opportunity to speak to this. We had, as a board and our various committees, over 700 members who took the time to make a public comment to ask us as a board to support House Bill 406. So I don't want to get in the weeds on this, but by the same token, I want to give enough detail so that everyone listening knows how seriously we took those public comments, how hard we worked toward getting to something that could be presented to our board. So immediately upon the filing of House Bill 406, our chairman and vice chairman, Lau Cheatham and Mike Foster, tasked me with understanding what the bill said, working with GRS to determine what it would look like for us to participate in a way that was similar, if not mirrored, what was being proposed for KRS and for the state police, and to work with the General Assembly to ensure that we had a full understanding of what House Bill 406 entailed. And I want to say to everyone listening, we worked on this very, very hard. And we were prepared today to have GRS walk through some numbers. I'm going to ask the chair eventually to bypass that and just allow me to speak to some of the things that have happened since our agenda was posted. As many of you know, our agenda is posted a week in advance of our meeting. So we posted our agenda, and then the day after our agenda was posted, some things happened in the General Assembly. House Bill 500 was conferenced, and it did not include a 13th check for KRS or for the state police. Now, it was important for us that 406 moved, because it was 406, House Bill 406, that gave us the authority to have an exception to what our statute says. Our statute today says we can only consider an additional payment if we're 100% funded and we're not, or if that additional payment is pre-funded. So House Bill 406 was giving us an exception to that. And so we did all the work with the expectation that if the board so chose, we would be able to utilize that exception. So House Bill 406 was filed with the House Appropriations Committee in late January, I believe January 23rd, and it did not move. So when House Bill 500, which is the budget bill, went to the Senate, it did not include any provision for a 13th check for K or for the state police. Once the Senate got House Bill 500, they added back provisions for K and for the state police, which would have allowed additional payments to be made. When that went to conference less than a week ago, it came out of conference without the 13th check. Now, it doesn't mean that there couldn't still be movement on that, because the legislators come back next week, go through the veto period, then they have 2 days that they can pass additional legislation. So if they were to pass additional legislation, I just wanted every member of CERS to know that we are well positioned to be able to put this information in front of our board. But by the same token, we have no statutory authority to get in front of the General Assembly. And for us to even discuss it now, when it's not on the table vis-a-vis the General Assembly, would be our getting in front of it. We don't want to do that. We are well positioned. If something changes in the legislature concerning 406, we're well positioned to be able to address it. But Mr. Chair, for all those reasons, I would ask that we not walk through the presentation that GRS had prepared for us here, but that everyone, including our committee and our board, know that the work has been done. There is no additional work that we will have to do to be able to execute against what the General Assembly may do. So with that, Mr. Chair, I'll turn it back to you.
Well, as I understand it, we're well prepared to move forward once we have the authority to do so.
Yes, sir.
Are there any other questions?
Mr. Webb.
Thank you. Not really a question, just a comment and a thank you. Really, that news I'm sure is disappointing to all our retirees. The legislature certainly has a lot of priorities to balance. So I can certainly understand the decision, as disappointing as it may be, but I am really happy to see that we were fully prepared with our analysis and to move forward with this. As you articulated earlier, this is far and away the number one thing we hear from members. So thank you, sir, for being fully prepared for this. Were that opportunity to come to bear.
Ed, do you have any sense of where the ball may bounce going forward in that regard?
No, sir. Only that bills can come out of the legislature for 2 more days, and I have no sense of what they will do with the remnant, if you will, of House Bill 406.
Well, odd things happen in the last few hours of the session, but on the other hand, that's the way it is. We'll have to live with it one way or the other. Yeah.
Yes, sir. We'll be ready if something changes.
All right. Thank you, Ed.
Mr. Chair, going back to tab 7, do we need to have a motion to accept though GRS's recommendation and to the assumptions for the new year?
We can, Mr. Cheatham, certainly a regular meeting, that motion would be well within the purview of the committee.
Glad to entertain a motion.
I'll make that motion. We accept the recommendations, keep the assumptions the same as the previous year.
Thanks for that motion. Is there a second?
Second.
Second.
We have is there any further discussion on the motion? Seeing none, we'll proceed to vote. All in favor of the motion, please signify by saying aye.
Aye.
Does anyone oppose the motion? Seeing none, the motion is adopted. Thank you very much for bringing that to our attention. All right, Ed, I've looked at my notes. I've run out of things to talk about. Do you have anything else we need to address?
No, sir. That concludes the agenda.
Okay. Well, thank everyone for joining us today. And if there's no further comments, I'll be glad to entertain a motion to adjourn.
So move.
Second.
There's a motion and a second to adjourn. All in favor, please say aye.
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 Anyone opposed? Seeing no opposition, the motion is adopted. I want to thank seriously everyone for your attention and assistance and participation today. We stand adjourned.
Thanks, sir.